Hello, good day everyone. Today we'll be discussing the topic of managing the finance function. My name is Mc.Kenneth Sawit and alongside with Marjorie Tangca and John Patrick Yadao. Okay, this will be the learning objective for this topic. The first one is what the finance function is. Second is determination of fund requirements. Third is the sources of funds. Third is the best source of financing indicators of financial health. The fourth one is the firm's financial health. And the last one is risk management and insurance. Okay, managing the finance function. It is essentially for businesses to sustain operations, grow, and minimize the risk. Finance plays a crucial role in decision making, from determining how much money a company needs to sourcing funds and managing the financial risk. The main idea here is every businesses, especially for engineering firms, requires effective financial management to ensure the funds are available when needed. Without proper financial planning, companies may struggle to maintain operations, pay debt, and invest in a growth opportunities. What the finance function is? Okay, the finance function involves managing money efficiently in an organization. It ensures that financial resources are well allocated to minimize the profits and minimize the risk. The responsibilities for this function is first one is budget and financial planning, setting financial goals and allocating resources. Second is cash flow management, monitoring money coming in and out. Um, Third is investment decision making. This is basically where you choose to where to put the company's funds. Third is risk management and insurance, protecting businesses from financial losses. And lastly, monitoring financial performance. This is basically evaluating the company's financial health. Now, imagine this. For example, a construction company must properly allocate funds for materials, labor, and unexpected expenses. If not managed properly, the project might be halted. They might stop the project due to a lack of funds. Now, determination of fund requirements. Why is it important? Before seeking funds, businesses must first determine how much money is needed and for what purpose. Fund requirements vary based on the company size, industry, and business's goals. The factors influencing the fund needed are these. The first one is operational expenses like salaries, rents, utilities, and daily costs. Next is capital expenditures, buying machineries, building, or technologies for enhanced productions. Third is expansion plans, like opening new branches or launching products. The fourth one is debt repayment. This is basically paying loans to maintain good credit score. And lastly is emergency funds, like saving money for unexpected financial problems. Now, imagine this. For a growing manufacturing company may need to invest in a new equipment to increase their production. By calculating how much capital is needed, the company can determine whether to apply for a loan or invest for their increase of production. Now that we understand how businesses determine fund requirements, let's discuss where they can obtain these funds. Our next reporter will be explaining the sources of funds and how to choose the best financing option.
Hello, I'm Marjorie, and now let's talk about the sources of funds. We have here the equity financing, debt financing, internal financing, government grants, trade credit, and crowdfunding. Once a company has determined how much capital it needs, the next crucial step is to identify the most suitable source of funds. Businesses typically have a range of financing options, each with its advantage and drawbacks. Let's explore the most common sources. The first one is equity financing. This involves selling shares of the company in exchange for capital. A startup, for example, might sell 30% of its share to investors in exchange for funding. The advantage here is you don't have to repay the money, but it does mean giving up a portion of ownership and decision-making control. Number two is debt financing. Debt financing means borrowing money that needs to be repaid with interest over time. An example could be a company taking out a loan from the bank to purchase inventory. While this option allows you to retain full ownership, the downside is the obligation to make regular interest payments. Next is internal financing. Here, a company uses its profits to fund future projects. A retail business, for instance, might reinvest its earning to open a new branch. This is often most cost-effective way to finance growth, but it can limit available sources for other investments. Next is government grants. These are funds provided by the government to support specific types of projects open in sector like renewable energy or innovation. For example, a green tech company might receive a grant to develop environmentally friendly technologies. The benefit is that this is non-repayable funding, but it often comes with specific condition and competition. Trade credit is a form of short-term financing where suppliers provide goods or services and allow deferred payment, such as paying 30 days after delivery. This can help businesses manage their cash flow, but it does require strong relationship with suppliers. Last one is the crowdfunding. Crowdfunding allows businesses to raise a capital from small investors online. For example, an entrepreneur might use a platform like Kickstarter to fund a new project. While this can be an effective way to raise funds, it requires significant effort to market the project and gain support. Choosing the best source of financing. So, how do businesses decide on what's the best funding options? Several factors come into play. We have here the cost of capital. Every financing choice has a cost. Loan requires interest payments, while equity financing means sharing a portion of the company's profits. It's essential to weigh this cost and choose what fits best for the business financial strategy. And control consideration. If maintaining control over decision is important, a loan might be the better option, as it allows business owners to retain full ownership. On the other hand, bringing investors through equity financing means giving up a portion of control in exchange for financial support. Risk tolerance. It's crucial to assess how much risk the business can handle. Can the company afford the regular debt repayments? Or if taking on an investor, is the business ready for the expectation that come with outside shareholders? We have here a real life scenario. Imagine a business needs quick funds. Should it take out a loan or find an investor? If the owner wants to keep the full control of the business, a loan may be the best route. However, if the business owner needs expert guidance or long-term growth support, seeking an investor might be the more advantage. Indicators of financial health. Understanding financial health is key for any business aiming to succeed. Regularly monitoring financial health help companies avoid potential risk and make informed decisions. Let's look at some critical financial health indicators. Profitability ratios. These ratios measure whether the company is making a profit. Positive profitability is essential for growth and sustainability. Liquidity ratios. Liquidity ratios assess whether a business has enough short-term assets to meet its immediate liabilities. It's crucial to ensure you can pay debts on time without jeopardizing operations. Debt to equity ratio. This ratio compares the company's total debt to its equity. It helps evaluate the financial stability and risk of business. A high to a high debt to equity ratio could signal financial instability. Cash flow analysis. Cash flow is king in business operation. Regular analysis ensures the company has enough cash on hand to meet operation costs and investment. Return on investment, or what we call the ROI, measures how effectively the company's investment are generating profits. A strong ROI indicates that the business is making the most of its capital. We have here a real life scenario. Consider a company with a high debt and declining profits. Without regularly monitoring these indicators, such as company may be at risk of bankruptcy. However, by keeping a close eye on financial health, businesses can take corrective actions before the situation worsens. Now that we've covered how to understand financial health, our next reporter will discuss strategies businesses can use to manage their finances more effectively and minimize risks.
Okay, so this is my report for today. Risk management and insurance. So, what is risk management insurance? So, it is a financial risk such as market fluctuations, credit defaults, and operational disruptions that can impact a business. So, why risk management important? So, like businesses face risks that could lead to financial losses, or a proper risk management could ensure a company remains stable despite uncertainties of the company. So here the types of risks: killer market risk, credit risk, and operational risks, and obviously the natural disaster. So the market risk is a changes in company, like the fluctuation and the interest rate. So, credit risk is a customer's failing to pay debt. Of course, hindi mo nabayaran. Or- And operational risk. So, internal failures and fraud or system errors. And of course, the natural disaster like fires, accident, floods, and whatnot. So, have here next. So like so up here the rule of insurance and risk management. So like business insurance protects against unforeseen losses, liability insurance several cover legal risks, and property insurance safeguard company assets. And employee insurance ensures workforce security. Workforce security. So let's just here like let's put a real life scenario. Like a logistic company, I suffered a warehouse fire, but because they had a insurance, the avail for an insurance, they recovered it without severe financial loss. So because of insurance, they recovered the business. And so in conclusion, in a managing a financial function is a crucial for a business success. So by determining the fund requirements, choosing the right financing, monitoring and financial health, and implementing risk management strategies, the company can achieve financial stability and long-term growth. So a financial management is not just about making money; it's about sustaining and protecting it. So thank you. So that's it for my report. Peace out.